Welcome back to Mind and Money. My name is Val Stratford and I am a financial planner.
And I'm Sherry, a financial coach. And today we are going to dive in all things credit score in Canada. So a lot of things will also apply if you're in the US or other places, but this is specific to Canada. So if you are not Canadian, you can of course listen, but then do a little more deep dive into what actually impacts your credit score where you live. So it's an area that I think a lot of people place more weight on than is logical. I don't know if that's the right phrase, but so many people are weighing what is going to happen with their credit score with every financial decision they make in their lives. And there are times in your life when you should do this. So if you are going to be like your goal is to buy a home in the next year or two, or you're going to be in the market to buy a car and you need a car loan in the next year or two, then yes, focus on your credit score and doing what you can to improve it. And it's always good to have those healthy behaviors that are going to relay into a positive credit score. But if you have no need for credit in the near or like next year or two, your credit score is not necessarily going to be relevant to things because it helps you acquire debt. And if you're not going to need to acquire debt, then it's thinking about your whole financial picture, and a little bit of the impact to your financial score is more of what I would recommend, because it's nice to have a high number and you don't want to do things that are intentionally going to hurt it. But like some people will keep a line of credit open that they know is going to like tempt them to use it debt wise, or they'll keep a credit card open, or they'll have enough money to pay off a loan, but they won't because they don't want it to hurt their credit score.
And your credit score is kind of like your adult financial report card. It shows lenders how you can handle borrowing money and paying it back. And there's two main credit bureaus that monitor our credit scores in Canada here. The first one is
Equifax,
and the other one is TransUnion.
Yep.
So those are the two main ones.
So and a question I get a lot is, which one is right? And the answer is they both are. They are both are right. In Canada, everybody will have two credit scores, and it is normal for them to be different. I don't think I've ever seen a situation where they're identical. It's normal for them to be different. This can happen because some items will only report to one credit bureau or the other, but also because they have slightly different formulas in how they're calculating things. So even if the items on your two credit reports are identical, your score is probably still going to be different.
So interesting.
It's so weird. And with both credit bureaus, your score can range from, on the low end, 300 to the highest end of 900.
Yes. And if you go on Google, there's kind of like a temperature gauge. It'll give you words for each section, like fair, good, great, perfect, blah, blah, blah. So when it comes to our credit score, what is it made up of? Like what makes up that? Just like a report card has French and drama and math, what are the classes on our credit score?
That's a good analogy. So the biggest thing that impacts your credit score is your payment history. So paying all of the bills and the debts that are on your credit report on time is very important, because if you miss a payment or you pay it late, it will have a significant ding on your credit score. So one missed or late payment is going to have a much more negative impact than the positive impact of making a payment on time. Missing a payment is going to take months and months of good payments to correct.
It's that hole again where one payment on time is a shovel into the hole, and one missed payment is a backhoe coming in and taking us through.
It's really, really hard to recover. And it's not that your score can recover from anything negative, but it all takes time.
It's a dance. It is a dance, and it takes time.
And it's really yes, it's an indicator of your financial health, your credit score, but it's a bigger indicator of how you're managing debt, because for somebody that doesn't have debt or has very little on their credit report, they can have scads of money in the bank. Maybe they bought a car for cash. Maybe they bought a house for cash. And because they're doing those things, there's no positive impact on their credit report.
Because they're not utilizing any debt.
Yep. So it's a score of how well you're utilizing your debt. And again, it is definitely a dance, because if you're looking to do things that need credit, a good credit score is going to save you a lot of money, because having a poor credit score, you're not necessarily not going to be able to access the debt, but it's going to be at a significantly higher interest rate. So if you're looking at a percentage point or two on a mortgage, like that's huge. I've heard people with car loans at interest rates similar to a credit card. And it breaks my heart, because if you need a car and you don't have a good credit score, you're going to sign on the dotted line and pay like fancy car prices for a not so fancy car, probably. We're going to talk about how you can work on your credit score and so make your payments on time.
Make your payments on time. What's the next thing that our credit score is made up of? What's the next class on our report card?
So the next class is your credit utilization. And this is one that gets people's eyes crossed a lot. So your credit utilization rate is a percentage of how much of the credit that you have available to you that you are using. So I'm going to use very simple numbers because my brain doesn't match complicated numbers. So if you have one credit card and this is specifically around revolving credits, credit cards, lines of credit, home equity lines of credit is what makes up your utilization rate. So if you have one credit card, that's the only revolving credit that you have on your credit report, and you have an available credit limit of $1,000 on that credit card. If you're using $500, then your credit utilization rate would be 50%.
Yeah.
But the other thing to consider is the timing. Generally, all of your credit cards, lines of credit, loans, they will report to the credit bureaus once a month. And for credit cards, that is on your statement closing date. So one day of the month, your credit card balance is what is reported to the credit bureau. So if you are carrying a balance on your credit card, making your payments as often as possible to reduce your utilization rate, knowing your statement close date and trying to make a payment before that statement close date is going to help you kind of like play the system a little bit and decrease that utilization rate. So a high utilization rate is not good, but a non-existent utilization rate is also not good. So below 30% is the best. Around the 10% mark, based on like my experiments in life, is more ideal. But also below 1% is not ideal. So I was telling Val before we recorded this, with TransUnion, before my credit cards reported, before my last score update, I had a perfect score. And after the last update, it dropped by 24 points. And the only change was that I had below 1% utilization rate. So, and this just speaks to, it's a score that talks about how well you are like managing debt. And they want you to be using debt to show that you're able to manage your debt well.
Yes, 100%.
So a below 1% utilization rate, they're like, she's not using this debt, so she must not be good at managing it.
She's not even showing up to class. How can we give her a grade? She's not even showing up.
So, and that is because like I'm paying the credit cards off in full every like pay cycle. So it's all about like the pay cycle and the timing of our statement close date. So it's a game, it's a dance. And the difference, though, between like an 800 or a 900 credit score when it comes to accessing credit is really limited. Like once you get over like 660, 700, there's really like not a whole lot of barriers to you for accessing credit. Like,
so we've got credit utilization, bill payments.
Yep.
So making that payment. And then next on the list is credit history.
Those, the utilization rate and your payment history, those are the two big ones.
Yeah.
And then we start to get a little more nuanced and some things that are a little harder to
Finicky.
finesse. So your account history, so how long you've had different credit products.
Yes.
So like the longer you've had credit products,
credit
the better.
card.
So if you've had credit, so if you're thinking about closing a credit card, but it's the credit card that you've had for the longest, just know that will decrease your credit history. Having a card that you've had for a long time. So if you're new, if you're looking for your first credit card, if you're younger or older, looking for your first credit card, I always recommend looking for a card that has no annual or monthly fees, because then you can just kind of hold on to it.
There's no harm to keeping it.
Yeah, even if you're not using it down the road, you can still keep it and just have it help maintain your credit history. Yep. So this is another one where if you have a car loan and you've had a car loan for 7 years and you pay it off, this is where you can see, even though it's a positive thing, you've paid off your car loan, it's decreasing your credit score because it's decreasing your credit history, especially if it was the longest thing you had on your credit report. So positive things can hurt your score, and it sucks, but it's the dance.
It's the dance. It's the credit dance.
And then again, on the lower end of impact are your different makeups on your credit report. So like the variety of credit products on your credit report. So
yes,
if you've got just a credit card
versus multiple credit cards, lines of credit, loans, potentially.
Any different, so like different things like revolving credit cards and car loans that have a regular payment. So it's just like, how can you manage different types of credit? So there was a little while there where we didn't have a mortgage. And when I would go on to my credit apps to see like what my score was, the recommendation would be to get a mortgage.
Go buy a house.
Like, how illogical is it that you're suggesting to somebody to help their credit to get a mortgage? A lot of times there's other factors that are holding you back from getting a mortgage, but also like that's a big commitment. And if you're like, I need to help my credit score, I'm going to get a mortgage.
Yeah.
It's like,
no. Because again, your credit score comes into play when you need debt.
Yep.
When you need to borrow money.
Yep, exactly.
Okay.
And then the last piece of the puzzle is your credit inquiry. So how many companies have you given permission to check your credit report? So
I can give a good example to this one. I had a friend growing up and they went vehicle shopping, multiple dealerships, multiple credit inquiries, like at every dealership did an application to see if they would get approved for financing for that vehicle.
And like the credit bureaus say that if you're shopping around and doing that, like for mortgages or car loans or credit cards, that it's not going
Soft
to
hit
have like, well, they all be hard inquiries, but it's like, if I have 6 car loans that I'm like applying for, they say that that's going to have a similar impact to if you were applying for one, if it's all around the same time, but they all show up on your credit report.
Yeah, I question that like, oh, we just group this into one.
Just know that if you're shopping around for something and you're giving permission, so a company is only able to pull your credit report if you sign a document and give them permission to do so. So just take into consideration how many people you're giving that permission, and it hangs around on your credit report for a while. But the further those inquiries get in the past, the less of an impact it does have on your credit report. So it's a makeup of lots of different things, and there are lots of different places you can check your credit score. And yes, it's important to check your credit score, but I think it's even more important to check your credit report for a variety of reasons.
Similar to checking your credit card statement.
Yes, check your credit card statements.
Please.
Get your head out of the sand, and your bank statements.
Yes.
Because if you're checking your credit report, not only do you see exactly what companies are reporting to the credit bureaus, because not all bills you're paying do. Most, a lot of telecommunications bills, so like cell phone, internet do. Some of the smaller companies don't, but your utilities and your rent and a lot of payments that are important are not actually reporting to your credit report.
Yes, this is a bit of a misconception. It's like, what doesn't matter on my credit report? So if you're paying your rent currently, it does not affect your credit score.
And there are some, I saw Borrowell just came out with a program you can pay into and sign up. And like more companies are starting to do that. And there are ways to get your rent reported, but it's not going to automatically come on there unless you're like, maybe if you're working with a really like large like rental company, it might, but in most cases your rent's not going to be there, but still pay your rent. But also the quickest way to see if there's been any type of like identity fraud or any accounts that are there or any inaccuracies, you need to check your credit report to do this. It does, like, it might show in your score, but it shows faster in your report. And the sooner you can catch things, the better. Because if somebody's been, like, if somebody took a credit card under your name and they haven't made a payment in a year and it's gone to collections,
that's on you, even though it's not on you.
Yeah, it's important to stay on top of those things. And there's lots of free ways you can check your report and score. Borrow Well, which I previously mentioned, is an app that's free, and Credit Karma. So Credit Karma lets you check your TransUnion score. Borrow Well lets you check your Equifax score. And when you're checking your score, it's not a hard credit inquiry. It doesn't impact your score for you to check it. So check it often. I recommend at least once a month just to stay on top of things, to see what's happening and what's going on with your score. Because again, the sooner you check things, the sooner you can correct them. And what are some things, Val, that don't impact your credit score that many people think do?
So your phone bill does, but other utility payments typically do not. So your hydro, your Wi-Fi, those are not going to be impacting your credit score. And unless you're registered with something that organizes it, your rent is not something that does that. Your bank account balance, your income level, what else could there be? Employment status, yes. Those do not impact your credit score.
They're not, like, they do show your current employer on your credit report, but it doesn't actually have an impact on your score. So if you are looking to make some changes with your credit score, or if you were brand new starting out, so if I could go back to like baby me just starting to get credit, the first thing that I would do is I would get a credit card and have like a no fee credit card that I could just keep and have forever and ever. So before the store credit cards that I got to get on my furniture, that would have been my first one. And I don't remember the first time I checked my credit score or report. It feels like something that I just didn't know.
I was much older.
About. Yeah. So being able to be aware of what's on your report, if you do go and check your credit report and there are errors on it, the first thing I would do is check with the other credit bureau. So if you go to your Equifax credit report and you see an error, first thing I would do is go and see, is that same error with TransUnion? And if it is, and even if it's only with one, the first thing to try is to reach out to that company that has the error on your report and find out like what's going on. Let them know that, like, if it's a credit card that you didn't take out, let them know it's not you so they can cancel the card. And then ask that company if they're able to like remove that error from your report. And if they are not, or if they're unwilling to, the next step is to reach out directly to the credit bureaus and file a dispute. And this, it's going to take time. It's going to be a pain in the ass. You're going to have to reach out to them multiple times. But if you've got, like, say, a missed payment incorrectly reported to the credit bureau,
it's not yours.
Having that corrected is going to have a significant impact on your report. So just like stick with it. If you've got errors, write down what the errors are and start to go through the process of filing disputes directly with the credit bureaus if that lender, if the company isn't willing to help you. And there are so many companies out there. I see a lot of advertisements on social media about, we'll repair your credit. We will take things off your report that shouldn't be there. And this is really just like they're trying to get your money. They are preying on you, as if you are somebody with a low credit score and you want to improve it. They're preying on you to try and get your money. And yes, maybe they can improve your score, but what they're probably doing is they're filing disputes with the credit bureaus for things that were actually yours and just hoping that they get removed. So if you file a dispute with Equifax to say that company ABC reported a missed payment, it wasn't a missed payment, they'll ask for some documentation. But what they'll also do is they'll reach out to that company and say, did this person miss a payment? And a lot of times, like, it's possible that the companies don't respond.
Mm-hmm.
So if they don't say, no, this was actually in fact a missed payment, then it's possible that it could be removed from your report, but you could do that on your own. So you don't need to pay a company to do it. It's just,
and just stick it out, follow it through, and follow up with it.
If it's yours, like,
own up to it.
Like I said, like, the biggest things that impact your score too are also, like, if you've got, and this is where it comes to payment history. If you have a debt that goes into collections, or you have a bankruptcy or consumer proposal, those are really big hits to your credit score, but you can recover with time.
Yes.
It's all about having a plan. And because ADHD sometimes means we miss payments and we forget about things, or we don't open the bill that comes, or we don't open the email that sends us the bill, I highly recommend setting up automation for payments, even if it's just for the minimum payment, because then you have that peace of mind knowing that they're going to get paid, that it's not going to be, even if you're paying the minimum payment and that's going to increase your credit utilization,
you're still not missing
the payment. And when you reduce your credit utilization, your score changes a lot faster than when you miss a payment and then make consecutive payments for several months. So if you are a young person, be on the lookout for your credit score, go and check, make sure everything's right. If you are not a young person, send this to a young person who is early in their financial journey, and like 18, go get a credit card. And one other misconception too is that if you add your child as an authorized user to a credit card or line of credit that you've had for a long time,
they'll just inherit.
The misconception is that credit card that you add them as an authorized user to will then show on their credit report and benefit their credit. But in Canada, this is not the case.
Correct.
Yep. If I have a credit card and I add my kid to it, or I add my husband to it, they have access to use the credit,
but it's not theirs to build.
It will not show on their credit report.
Attend class.
I believe in the States will in fact help if you add an authorized user, but also if you are in the States and adding an authorized user, if you've got high credit utilization, if you've got missed payments on that card, know that yes, they may be inheriting credit history of a card you've had for 20 years, but they're also inheriting the good
with the bad
and the bad. So I think it's better, just like in any case, just have them start young, teach them how to manage credit responsibly. If you're not able to use credit responsibly and you're nervous getting a credit card, but you want to help your credit, get the card in the mail, cut it up, shred it, don't actually use it, even though you'll have zero utilization, you'll be building credit history. Or you can even put
one bill on it, put your Spotify on it.
Yeah, put your Spotify, put your Netflix subscription on it.
Yep.
And automate a payment to that card the day after your billing cycle closes, so that you're reporting that payment every month. Yep. And there's ways to do it, and it doesn't necessarily involve opening yourself up to risk and that taking on debt. Keep that balance low on your cards. Make your payments on time, and just be patient, and your credit score will trend in the upward direction.
Yes.
We are glad you've been here learning all about credit scores, and we can't wait to see you next time on the Mind and Money Podcast.